welcome back to our YouTube channel Finex. I hope you guys must have learned from our previous video regarding the background about Vijay Kedia sir and the transitions from trading to investing. And you have also learned few of the insights and investment ideologies from the various case studies. Right. In this part, the further will be taken over by Anuj and Aryan, explaining you the investment process and few more insights about Vijay Kedia sir.
You guys have understood all the case studies of Sir Vijay Kedia, and now I'll continue with their investment ideology. Their investment ideology. In the investment ideology, we will basically talk about what filters does Sir use in his investing process, and what all companies does he entertain and study about, and then goes further on to investing in them, and what all companies he just ignores. So his investment ideology is known as SMILE, where S stands for small in size, M stands for medium in experience, which is the company should have a history, which is a track record. I is just for the completion of the abbreviation, where L stands for large in aspirations, where L stands for large in aspirations and E stands for extra large market potential. So we'll just go through these one by one and try to understand what does he actually mean by the SMILE ideology. So we'll first start with small in size. So, Sir primarily invest in small and mid cap stocks. Now, what exactly are small and mid cap stocks? So I'll just take it through here. Yeah. Uh, yeah. So, to understand what are basically small and mid cap stocks, we will go to this website called AMFI, which is Association of Mutual Funds of India. We'll go to this website and we will click on research and information. Then we will move on to the other data and we will look for this categorization of large cap, mid cap, and small cap stocks. So basically, this website of AMFI provides this data on, as you can see, this data is available 6 monthly data, that is semi-annually. This data is available on a semi-annual basis. So if we just click on this, it will get downloaded to our Excel, and let's check out this file. Yeah. So as we can see here, this is the file. So these are all the listed companies on BSE, which is the Bombay Stock Exchange, and they have categorized those companies in three types, which is large cap, small cap, and large cap, mid cap, and small cap. So here, starting from Reliance Industry, small cap, large cap, and mid cap are basically based on the market capitalization. Market cap. Market cap is nothing but the price of their share into number of outstanding shares. So the largest company in listed on BSE according to its market cap is Reliance Industries. So the company one to company, as we scroll down here, to company 100, which is PI Industries. So from company one, according to its market cap, to number 100 are classified as large caps. From number 101 to number 250 are classified as mid caps, and from number 251 to how so many companies are listed on BSE are classified as small caps. So as we can see, there are around 5072 companies listed on BSE. So from number 251 to number 5072 are classified as small caps. So let's move on to our PPT again. Yeah. So he believes that these companies have the potential for significant growth and can generate substantial returns over the long term. Now, we will give more emphasis on the long term here, and again try to understand why does it think that these mid and small cap companies would generate higher returns in the long term. So we'll just move on to this website of S&P. So this website provides data about stock indices. You can use this website to our benefit and understand how some stock indices have done historically. So what I've done here is I have chose these four indices: S&P BSE 500, which is nothing but the top 500 companies from BSE, which we just saw earlier here in our Excel sheet. That is number one to number 500. Yeah. Yeah, from number one to number 500, these S&P BSE would give the returns is an index. So S&P BSE 500 is an index of the top 500 companies listed on BSE according to their market capitalization. Next, what I've taken is S&P BSE small cap. So it includes all the small cap companies. Then I have included S&P BSE mid cap and S&P BSE large cap. Now we will just put this here. If we click on compare and just add and just search like BSE small cap, yeah, we can add these indices to for a comparison. So if we just click on apply, yeah, the starting point for each indices here is 100. So as Mr. Kedia suggested that over the long term mid and small cap stocks generate a higher generate substantial returns compared to large caps. So we will just prove his analysis right here. As we move to long term, we will just take a 10-year horizon. So if we see here, S&P BSE 500 gave returns moved from 100 to 333. BSE small cap moved from 100 to 496. BSE mid cap went from 100 to 415, where large cap went from 100 to 303. So as we can already tell here that BSE small cap gave the most returns. Now we will just put these numbers into an Excel. Yeah, we'll just go BSE large cap, BSE mid cap, BSE small cap. Yeah. So if we were to put this number, put these figures in an Excel file, this would be our start point. Start point. All the three indices started with 100. Yeah, and ended with, which is nothing but these is our opening and these are our closing values. So we will move on to our chart again. So our closing prices would be for small cap it's 500, for mid cap it's 422, and for large cap is 308. Yeah. So we'll just go here is 500. Sorry, this is 308. This is 420 approx, and this is around 500. So if we were to calculate a CAGR, so here from 2013 to 2023, which are 10 years. So we'll just calculate the CAGR, which is calculated by the rate formula. We'll type in rate and hit the tab key. So NPER, which is nothing but number of years, we'll write 10. PMT will be 0. PV is always put in with a minus sign. So minus our opening value, comma our future value, which is nothing but our closing value. Type 0 and we hit enter. So this generated 12% return, mid cap generated 15% return, and small cap generated 17% return. So if we were to put a traditional formatting over this, so these were the performance of the small, mid, and large cap indices, and that's how we can conclude that small and mid cap stocks give substantial returns over and above the large cap stocks over a longer period of time. So let's move on to our PPT again. Yeah. Yeah, we have understood till here. So then, Sir tends to maintain a concentrated portfolio with a limited number of high conviction stocks. He emphasizes the importance of patience and holding stocks for the long term. He believes that giving companies enough time to execute their strategies and grow their businesses is crucial for wealth creation. So, in this small in size point, what we concluded here was he is very fond of mid and small cap stocks. He only invests in mid and small cap stocks. He believes that they will generate significant returns over the long term. He chooses to buy only and only few stocks, which is he has a concentrated portfolio, and he only buys stocks on which he has conviction on. He has his bet on, and try not to diversify his portfolio much, and prefers to as he has also mentioned in the book that prefers that he will only get one or two investments in a year. He would be satisfied by those, as he is a man who only likes his portfolio to be concentrated and not much diversified, and wants to only buy stocks which he has conviction in. Yeah. So moving on to the M of smile ideology. So M is medium in experience, which is nothing but with a track record. So, sir looks for companies with a track record of at least 15 years. The company should have a track record of at least 15 years. He believes that companies with such long histories are likely to go through multiple economic cycles and have learned from the mistakes. As also the Mani sir has emphasized on learning from your mistakes. The same rule for investors applies for the companies as well. He says that he evaluate companies whether they stick to their core competencies or frequently venture into unrelated areas. So that's how he analyzes companies. He look for a track record of 15 years, at least 50, he look for the track record. It should be minimum 15 years. Then he goes on to understanding if they have stick to their core competencies. Core competencies is nothing but the business which you are meant to be doing, which you have started the company for. Now let's take an example of this. Sir mentioned a company called Jayashree Industries. So sir took an example. So sir gave an example of company named Jayashree Tea and Industries. So what happened with this company is Kedia sir were invested in this company. And the primary core competency of this company was to produce tea and to sell it in the markets and book profits. So what happened is they ventured into a altogether new industry of sugar. They went from tea producing company to a sugar producing company. So, sir thought that they are switching up their core competencies and are not and will not be able to focus much on their core business activities. So he exited the stock, and as we all can see, from 1995 to 2010, the stock went up. But as soon as they ventured into other fields, the company was not able to generate profits from their core, as the company's responsibilities were diversified, which led to the stock price falling post 2010 period. So I'll just inform you guys how we actually calculate how we actually get this data and where do we get this data from. So if we just type in Jayashree Tea and Industries historical share price and click enter, it is available on BSC as well, but we won't be able to extract the data. So the first site, which is investing.com, we'll just click on it. We'll choose our timeline from here. The company came into existence at around 1996. So we'll just choose an year from here and just click apply. And we will choose our data to be monthly. Yeah. So as soon as we click it on monthly, the data will be arranged in a monthly manner over the years, starting from 1996 and till 2003. So we can copy paste this data like this I have done here, and then insert a price chart like this. Yeah. So we have done with the core competencies, and another point to be noted here is he employs a bottom-up investment approach. Bottom-up investment approach is focusing on analyzing individual companies rather than making investment decision based on macroeconomic factors. Macroeconomic factors might include government policies or some economic trends or some new regulations. So he basically look for companies which are fundamentally strong with sound business models, which may have competitive advantage and capable management teams. Now moving on to the L of the SMILE ideology. So L stands for large in aspirations. So Sir evaluates management based on three attributes. The aspirations part is related to its management and its business processing. As in what type of people manage this business and what are their aspirations, what are the goals, how they are, their personality, and all. So basically, I'll correct myself. He evaluates the management based on three attributes, which is hunger, honesty, and smartness. So honesty refers to is important for creating value not only for themselves but also for shareholders. So honesty can be determined by factors like if the company is raising cash and it announces in their corporate announcements that they are raising money for doing capital expenditure. They have to build some machines. They have to they are raising capital for debottlenecking or anything, and they also mentioned that it will take 1 or 2 years, and as an investor we can do nothing but have trust in in the management that if they are getting money, they would invest it in the right place for the benefit of the company, as only if the management is putting efforts into the is putting effort into the company, both the management and the investors will make money, and the investment will be fruitful. So the first point being honesty, next being hunger. So hunger refers to the drive to continue growing the company even after the initial success, with aspirations to grow regionally, nationally, and then altogether internationally. So for understanding hunger, we can take example of companies like Apple. So we all know how much of a big success the Apple company is, but the hunger to grow, the hunger to continue being better than what they were one iPhone model ago, is what is driving the company. They kill their own products by producing new and better quality products than their existing product. So that's how hungry the management should be, is what sir is trying to tell you. The next of the factors being smartness. So smartness relates to the management's ability to navigate crisis and seize opportunities. So basically, this point connects to the medium in experience with the track record point, where the management being having more than a 15-year track record, and seeing various economic cycles economic cycles can lead to market crashes, as we have all seen the dot-com bubble burst of 2000, the US financial crisis of 2008. Then we all know the COVID crisis of 2020. So as businesses go through such market crashes, such economic crisis, that's where businesses learn and grow onto managing these companies. So that's how we can correlate this point of the management being smart to having a track record and learning from our mistakes. Along with the management, he also give attention to the risk management, which is the risk associated with its investment. He conducts thorough analysis and research, assessing factors such as financial health, which is the health of which is the health of their financial statements. Are they generating cash flow? Is the revenue growing? Are the PAT margin growing, or at least staying the same? How is the market share of the company? Is it decreasing? Does the company now has any competitors in the field? Which is also included in industry dynamics. Then if the company has any moat can be simplified as competitive positioning, which is nothing but competitive advantages over the companies, which doesn't allow other companies to which doesn't allow other companies to enter the field easily and take your position. So that's it for the large and aspiration parts. So the next part of the smile ideology be extra large market potential. So as the company, he invest in being small and mid caps. So as we all saw that over the long term they generate extraordinary returns, but he is not satisfied with 2x returns or 3x returns. He at least looks for a 10x returns, which is nothing but a 10 bagger. Sir generally avoids buying stocks with high valuation. He prefers stocks which are trading below the PE of 10. We have already discussed about why a PE below 10 is considered cheap or lower, but we'll just go through it again. So just we'll have a complete understanding of the topic. So here it is. We have discussed this solution in the previous part of Mr. Ramesh Damani, but we will just go through it once again. So here the price to earning ratio, which is nothing but market cap by PAT, or price per share by divided by earnings per share. If we take it as 8, which is 8 rupees of market cap and a PAT of 1, which means for every 1 rupee PAT the company earns, we as investors are giving the company 8 rupees. So inversing this ratio to E by P, the E by P ratio would be 1 by 8. So the return generated from it, I'll just do it again, 1 by 8. So the return generated from it would be 12.5%. And we consider that these stocks would not grow in the future, which is they would continue giving 1 rupee part over the years, and we will generate a return of 12.5% every year. So comparing no growth, so there's only one instrument which gives no growth, as its returns does not compound, which is fixed deposits. So fixed deposit are mainly available at gives say 6% returns, right? So if we consider an alpha, which is the returns generated over and above the fixed deposit rates. So here buying a stock at 8 PE will give an alpha over the fixed deposit which does not grow an alpha of 6.5%. And if we were to put a 10 PE here, it will still give an alpha of 4%. So remember, guys, we are talking about no growing stocks here. And as we all know, sir invest in mid and small caps, which are known to generate returns, which is how give higher and higher growth over the long terms. So basically, his ideology of buying companies below a PE of 10 is justified through this example. Yeah. So buying per stocks at so we understood how buying stocks at a PE of 10 or below 10 is very lucrative. So we will go on to understanding the last point, which is, however, he does make exceptions for high PE stocks if he believes in their long-term growth potential. He is willing to hold such stocks for a longer period, expecting that the growth will eventually justify the higher valuations. He aims for a growth rate of at least 20 to 25% in the stock he invests in. So as we already discussed this, that he buys mid and small cap stocks which he has conviction in, as he only has a concentrated portfolio of the stocks he has conviction in. So he buys even if he buys at higher valuations, and yeah. So even if the stocks which are not growing that much at this point are available at higher valuations, he would still buy them, as the growth which is to be generated in the near future, 2 3 years down the line, will justify the higher valuation which he will be paying today. And he also mentions that whenever he buys PE at whenever he buys stocks at higher valuation, he generally assumes that he won't earn anything from it for the next 1 to 1.5 years. So that's how his ideology works. So I hope now you are very much familiar with Mr. Vijay Kedia's investment ideology of Smile. And let's move on to the next topic. Okay, so after that, let's move on to this next slide, where we have actually mentioned how mistakes can turn into life lessons. We all have heard even Ramesh sir saying, and even Kedia sir saying, do mistakes, do a lot of mistakes, but do new mistakes, and learn from your past mistakes. So how did Mr. Kedia learn from his mistakes? We will understand this through a case study of Sarah Sanitary Ware. So basically, what happened was Mr. Kedia entered Sarah Sanitary Ware during the 2007 period, where the stock was trading at 100 rupees, and he sold the stock in the year 2012. So he hold on to the stock for almost 5 years, and when he exited the stock price was around 250 rupees. So the return that he generated would have been 2.5x of his initial investment. So let's get started with the case study. So Sir made a mistake by selling shares of Sarah Sanitary Ware way too early at previous price level, missing on substantial gains. So let's just understand this in more clearly. So as we can see here, this was the period during which he was invested. If you can see my cursor, from 2007 to 2012, where stock price went from 100 to 250, and as after the period he exited the stock, which is from 2012, from 2017, which is also a 5 year period, the stock actually went from 250 to the heights of 3,600 rupees. And currently the stock is trading at around 7,700 rupees. So if he were to hold on to the stock for the next 5 years, he would have generated exorbitant returns, almost a 360x return from the stock. So here he learned the importance of holding shares for the long term, following the approach of successful investors like Sir Warren Buffett, late Sir Rakesh Jhunjhunwala, and R.K. Damani, who is Radhakishan Damani, who is actually the owner of Avenue Supermarts, which is DMart, and Ramesh Damani sir is actually the chairman of DMart. So from this case study, Sir realized that one should not sell shares just to book short-term profits, but should focus on the company's growth potential and hold on to the share as long as the company continues to grow. Uh, from this case study, till his investing journey till now, he adopted a mindset of seeing a company from a owner or a management perspective rather than a shareholder perspective. So this helps him to make more informed investment decisions. So to break this down, he started focusing more on the company's growth, on the company's valuations rather than profit booking. So that's how he developed a mindset of overviewing the company the company's owner or management perspective rather than an investor specific perspective who is just focused on profit booking. As Mr. Kedia mostly invest in small and mid cap stocks, it is very normal for such stocks to get affected by market price fluctuations. To understand this better, I'll explain the concept of float. So what happens in small cap company is, firstly, they are small caps because their market capitalizations are low. As we have discussed in the earlier part, their market capitalizations are low, and most of the shares of such small cap companies are held by the promoter itself. So the float would be the overall shares of the company minus the shares which are with the promoter, the shares which are held by the promoter. So the only shares, investable share, which are available to the general public are known as float. So what happens in such small cap stocks is, the float being so small, the float being so less, whenever there is investment, there is bulk investment in such stocks, these stocks can easily rally through and can be and can be a can be a victim of market fluctuations. Even if there is a high sell-off, the share price might drop like 15 to 20%, or if there is a high buying, the share price might grow by 15 or 20%. So as Mr. Kedia's investing journey moved forward and forward, he understood that due to these reasons, the price fluctuations may be temporary, and he should focus more on the company's growth potential and hold the shares as long as the company continues to grow. And I'll finish off this case study with a last question by the interviewer to Mr. Kedia. The interviewer asked, there are very bright people who have done academically so well in their respective industries, but why do they fail in stock markets? To which Mr. Kedia answered, not every CA is Rakesh Jhunjhunwala. So to explain it, he further explained that CAs generally read lots and lots of balance sheet. They actually do the accounting of balance sheet. But then again, reading and understanding such finances of great companies, they come back home and just buy around 100, 200, or 500 shares of these companies, and they tend to sell those off after seeing some price movement to book profits. So that's what he wanted to say, that every CA, or every not actually targeting CAs, the only people who will the only bright or intelligent people who will be able to make money in markets will be the ones who would have the courage to not sell during such price fluctuations, and believing on the company's management and believing on the company's growth, that it will reach its potential one day, which will lead to them making higher and higher profits. So that was the whole case study of Sarah Sanitaryware. Now let's move on to our next slide. Move on to understanding some key learnings and some major takeaways from the topics discussed further in this chapter between the interviewer and Mr. Kedia. So first they talk about some common threads and stock successes of Mr. Kedia, what makes their stocks successful, and how multi-baggers are created. Next, they have discussed about some factors of selling, detachment from investments, and impact of market movements. So we will go one by one. So the common thread in stock successes of Mr. Kedia. Investing. So he says that investing in relatively unknown or unpopular companies with capable management. Unknown and unpopular companies, as they are as he mainly invest in mid and small caps, they are very unheard of. They are good companies, but they are very unheard of. Which These small and mid cap companies should have capable management, strong business prospects, and illiquid stocks. Initially, these stocks may not attract much attention, but as more people invest and institutional investors join in, the stock starts to gain momentum. Institutional investors can be domestic institutional investors like our mutual funds and insurance companies, as well as foreign institutional investors which invest in India. So what he basically wanted to say is to buy unknown or unpopular stocks, and be one of the first wave of investors to invest in such stocks, as we saw in the case of Mr. Ramesh Damani, as he was one of the first wave of investors to invest in Infosys, and how it helped him in generating higher returns. And he also talked about characters such as strong business prospects, capable management. So that's how we can interrelate between the ideologies of these two investors. Next is factors for selling. He mentioned some factors for selling, which include manage changes in management focus, as we saw in the case of Jai Shri Tea and Industries, where the management's focus changed from producing tea to sugar, and how it affected the stock price, and how Mr. Kedia exited the stock as soon as he saw the focus of the company shifting from the core business. The next would be exorbitant valuations that the company has crossed its valuation, which happened with Sir Ramesh Damani in the case of Infosys, and how he sold off his entire stake in Infosys in the year 2000. Then comes the volume of stocks to be bought or sold. This may be in anticipation of a bear market. The high volumes are sold by huge institutional investors. He suggests that in a bear market, when there are huge sell-offs by investors, it does not matter. The company's fundamental or financials does not matter. The company is doing great. The company's management is great. It does not matter. When there is an anticipation of a bear market, even the highest of stocks gets squashed. The next point which they discussed was detachment from investments. He suggests that once an investment is made, it belongs to the market, and when profits are booked, they become the investors. Emotional attachment can hinder one's ability to make significant gains, as we already saw in the case study of Tata Robinson Fraser, as how the stock moved to the highs of 2200, and there were reports published that the stock might move to the highs of 10,000. But then some news got surfaced about the company, and there was a huge FII DII sell-off, which led to the stock getting absolutely crashed. And unfortunately, Mr. Kedia were able to sell it around 1100 and 900 range, and then eventually the stock went to the lows of 100 rupees from the highs of 2200 rupees. So that's the message he wanted to say, that whenever such factors come into position, we have no choice. We cannot get attached to the investment की अरे नहीं रे ये तो स्टॉक अच्छा है, इसका अब इसका तो वैल्यूएशन भी मेट नहीं हुआ है, इसका मैनेजमेंट अच्छा है, इसका ग्रोथ अच्छा है. We do not care about such parameters. When there is exorbitant when there are exorbitant fluctuations in a stock due to such factors, we have to get detached from our investment and sell those stocks. Let's move on to the last point, which is impact of market movement, which actually says that if falling stock prices in a normal market may cause concern, but if the entire market is declining, there may be less reason to worry. Which means if the whole market is on a downward trend, and along with the market sentiments, your investments are also on a downward trend, it may be less worrying. The cause of more worrying would be if a stock is not rising along with the overall market, it may indicate structural problems. So to understand this better, I would like to show an indicator here. Yeah, yeah. So let's understand this indicator step by step. These are the number of companies listed on NSE, which is our National Stock Exchange, as on 31st March 2023. And here are the companies hitting 52-week low, which is nothing but 52-week low is the share price of the company, is the of how many companies is the lowest during the 52 week are is a span of 1 year. So there, out of these companies, 2137 companies, 10 companies has hit their 52-week low prices. So that's a percentage of 0.5%. And companies hitting their 52-week high are 100 companies. So that's a percentage of 4.7%. So to judge the current state of the markets, if we calculate this, companies hitting 52-week low divided by companies hitting their 52-week highs. So the ratio comes out to be at 0.1. 0.1. So how to conclude this? If this ratio hits around 2.5 to 3-ish, then we can conclude that market has hit the bottom, which is the companies hitting their 52-week lows are more are 2.5 to 3 times more than the companies hitting their 52-week highs. And if this ratio is below 1, we can conclude that the market has hit its top or is moving towards its peak. So right now the ratio is at 0.1. And where to source this data from? We can just simply search 52-week low and high NSE, and just go on NSE India website, and here the data is available pretty easily. And here are the securities which are at their 52-week highs, and here are the securities which are at their 52-week lows. So with this indicator, if this indicator is less than one, which is the market is moving towards its peak, and still for some weird reason, your investments are on a declining trend, are not giving returns or are giving negative returns, then there might be a cause of concern that there's actually something wrong with with the company you have invested in. So these were the major four takeaways from the interview, and I hope these were very informative and educational. And that's it for this part. Now I'll let Aryan take over and explain the further topics of this chapter.
So let's discuss about the learnings from the portfolio structure of Vijay Kedia, sir. In this part, we will discuss about the five learning. First is about risk management. Second is about avoiding overexposure. Third is about opportunity for growth. Fourth is about flexibility and adaptability. Fifth is about long-term perspective. So let's start with so before starting with key learnings, first we will see how Vijay Kedia sir structures his portfolio. So let's move towards the portfolio structure part. Vijay Kedia sir portfolio structure includes 10 to 15 major stock in which he allocate majority of his corpus, 20 stock which will have lower allocation, and Vijay Kedia will not allocate more than 10% to the any particular stock. So one can see Vijay Kedia portfolio is like he will allocate around 50 to 70% in his major stock, which are 10 to 15 major stock, and the remaining part of his portfolio will include 20 stock with a lower allocation. And the important learning is Vijay Kedia doesn't allocate more than 10% in any particular stock. So let's now jump towards the first key learning, which is about the risk management. In the risk management, we can see that Vijay Kedia doesn't allocate more than the 10% to any one particular stock. So what are the benefit of that? The benefit of that, if it will reduces the loss amount because of a failure of one particular stock, as a portfolio will include the number of investment in the number of stocks, so which will have less impact on its overall portfolio. Vijay Kedia's approach is of diversification in a portfolio, which will help to reduces the risk. So let's now understand with an example. If a person portfolio considers about a 10 stock and he has invested majorly in an 3 to 4 stock, so due to the failure of that 3 to 4 stock, which will overall degrade the portfolio performance. So if a one approach is about diversification in its portfolio, it will reduce the significant risk of losing money with the use of diversification. Diversification is one of the crucial and the most important requirement for the systematic risk management. So let's now move towards the second part, which is about avoiding overexposure. Sir Vijay Kedia sir has put a limit of a 10%, so that he will not allocate more than 10% in any particular stock. The benefit of this it will mitigates the risk of losing money in your portfolio due to the stock underperformance or face adverse condition, ensuring a diversification and reduce the reliance on any one stock performance. So in avoiding overexposure, Vijay Kedia discussed that he will not allocate more than 10% in any particular stock. The benefit of that is that if one particular stock will fail, it will not. This portfolio will his portfolio will not depend on that one particular stock. If a portfolio is depend on the one particular stock, then there will be a significant risk because of the major investment in that particular stock. And if there is underperformance or the company faces an adverse situation, it will affect the portfolio performance. Now let's move towards the third part, which is about opportunity for the growth. Diversifying your portfolio enable you to capitalize the growth opportunities from the different sectors and the company beyond a single stock if you have in which you have high conviction in it. Limiting the larger position allows the other investment to contribute to the portfolio. So here the Vijay Kedia says that the diversifying your portfolio will increase the chance of a growth of opportunities as you will invest in a different sector beyond the one particular major investment in a one particular stock or industry, which will limitate the larger position and allows the other investment to contribute to the overall portfolio growth. So let's understand this in a whiteboard. Let me delete my earlier working part. So this is a portfolio of a 10 stock. Let's divide the portfolio into the two parts. The first part is a 50%, which is investment in a technology stock, and other 50%, which is invested in another sector, let's say like real estate, and let's consider other as a FMCG. Let's consider third as a steel sector. Let's consider four as a automobile sector. So this is a particular allocation of a one person's portfolio. Let me use a spotlight. Okay, so if a person has a portfolio of a 10 stock, if he has allocated 50% in a technological sector, he will surely get benefit from the growth opportunities of technology sector. Along with it, he will also able to get opportunities by allocating to the different sectors like real estate, FMCG, steel sectors, and automobile sector. If there is a strong growth opportunities in any of this sector, which will result in the growth of portfolio, as a result of which overall portfolio value will be increasing. So these are the learnings. These are the learnings for the growth and opportunities by the diversification. Let's move towards the PowerPoint. Now we will move towards the fourth part, which is a flexibility and adaptability. Let me use a spotlight. Okay. So with the smaller allocation to the larger stock, you can easily adapt it to the changing market condition and swiftly and adjust your portfolio. This flexibility enabled to respond to the effective to the emerging threat and a potential risk based on the new information. So, what are the learnings of flexibility and adaptability? For this, we will use the portfolio structure of Vijay Kedia. The portfolio structure of Vijay Kedia includes 10 to 15 major stock and other stock which will have lower allocation. So Vijay Kedia in which he stock in which he have lower allocation and a stock moving in the same direction as per sell investment analysis, he will sell some of his major stock. He will sell, let's say, some portion from his major stock and move that money in the stock in which he has lower allocation. As a result of it, the allocation in this lower allocated stock will increase. So portfolio will be shift from 10 to 15 major stock. Money will be shift from 10 to 15 major stock towards the stock which have a lower allocation. What are the benefit of it? With a change in market condition and increasing and growth opportunities in other stock or other sector, so can easily able to shift the money from this higher allocated stock to the lower allocated stock. As a result of it, the portfolio performance will be increased because of increasing an investment in the lower allocated stock, which have the high growth potential compared to the major stock. So let's understand with the example. If let's now in today's time there is a more craze about AI. Sir doesn't have any idea about AI, but he had developed the basic understanding about AI and invested, let's say, small amount in a various AI company. And if investment started moving in the direction as per the sir's thinking, he will reduce he will sell his major he will sell some portion from his major stock and move the investment towards the AI, because as AI now will have more growth opportunity. These are the learnings from the flexibility and adaptability. Long-term perspective. To succeed in a long run, it is an important to diversify the portfolio and manage the risk. By limiting the allocation to any one particular stock, you will increase the likelihood of earning the consistent return and reduces the impact of short-term market volatility, and you can stay focused on your portfolio goals. Now, so the long-term perspective is a combination of all the learnings which I had understood throughout this video, throughout this slide, not the video. So in this, the Vijay Kedia says that if a person will diversify his investment and manage the risk, along with it, he will shift the portfolio according to the new opportunities and new growth perspectives. He will able to earn a handsome return on his portfolio, and his portfolio will be less affected by the market volatility, and he can say strong focus on his portfolio. Key learnings from the investment circle of Sir Vijay Kedia. So in this slide we will first discuss about the what are the learning that Vijay Kedia sir had got from his investment circle. Then we will discuss about the Vijay Kedia sir had expanded the learning of Sir Rakesh Jhunjhunwala's about courage. Now let's begin with our first part. Sir Vijay Kedia was among the greatest listener in his investment circle. Sir Vijay Kedia was the least educated in his investment circle. So when he meet any investor, he simply sits and try to absorb the maximum thing from that investor. Now, Rakesh Jhunjhunwala sir has a great influence on Vijay Kedia sir. So when they both meet, Vijay Kedia sir simply listen and try to absorb the maximum thing from the conversation. Sir Rakesh Jhunjhunwala had taught an important lesson about courage to Vijay Kedia. In the markets, you require courage. Without courage, you cannot make money in the market. These are the learnings which the Vijay Kedia sir has got from Sir Rakesh Jhunjhunwala. Now, let's connect our earlier understanding and this understanding. In earlier, we had discussed about the key learnings from the investment circle of Ramesh Damani sir. In this, we had discussed about the key learnings from the investment circle of Vijay Kedia sir. What are the common things? In this, there is a one common investor, which is Rakesh Jhunjhunwala sir. So Rakesh Jhunjhunwala sir, key learnings for Ramesh Damani sir and for Vijay Kedia sir are the key learnings for our all of us. So what are the key learnings for Rakesh Jhunjhunwala sir? Rakesh Jhunjhunwala sir, key learning to all of us is you have to have strong conviction and you have a courage to invest in the market. Then only you will able to make money in the markets. So now let's move towards the second part. In the second part, Sir Vijay Kedia discussed about the key learnings from Ramesh Damani sir. In the key learnings of Ramesh Damani sir, he discussed about his morality and capacities of learning. Now let's connect this with our earlier learning. In earlier, we have seen the reading habit of Sir Ramesh Damani. Sir Ramesh Damani was highly passionate about reading. He got his reading habit from his father, which he has passed into his son. We had seen the various talk about the reading habit of Sir Ramesh Damani. So here I briefly highlights about the reading and the learning capacity of Sir Ramesh Damani, which has greatly influenced Vijay Kedia sir. Now, Vijay Kedia sir expand the part of courage which he had learned from the Rakesh Jhunjhunwala sir. He ends the discussion by courage. In the stock market, people have two types of courage. The first type of courage is they have rupees 100 and they invest rupees 20 in a stock. And the second type of people courage is they borrow 100 and invest in a 20 cent. The second type of courage is not necessary in the market. Yet market need courage, but not that kind of leverage like courage. What matters in the market is a systematic methodologic investment. So these are the key learnings from the investment circle of. So let's begin with the macros and personal of Sir Vijay Kedia. So let's discuss about the macros and personal. This slide is divided into the five parts. I had prepared this slide from the questions which author has asked to Vijay Kiriasan and Vijay Kiriasan has replied to that answer. These are the five key learnings that I had presented in the slide. First, we will discuss about macros. Then we will move towards the views on disruption. Then we will move to about some personal part. Then what are the common reasons for failure? And lastly, we will conclude about key to success in the markets. So let's first discuss about the macros. Sir Vijay Kedia doesn't look at a broader macro. He look at a sector specific macro. What are the reason for looking at a sector specific macro? He says
that market has fallen in rising interest rate also, market has fallen in fall in interest rate also. So he doesn't consider of looking at a broader macros. Now, what are the sector specific macros and what are the broader macros? Sector specific macros and the macros which include like if suppose consider I am an investor in a steel industry, I have a deep understanding about the steel industry. So for me, the price data of a steel at a global levels, what is happening at a global level in steel industry are some macros which I will look. So these are the sector specific macros. So what are the broader macros? Broader macros are like interest rate, inflation, balance of payment, foreign currency, depreciation, etc. are the broader macros. Vijay Kedia sir mainly focuses on the sector specific macros. Now, we will move to the next part, which is about the views on distraction. Sir Vijay Kedia consider disruption is what is interrupted will be disrupted. Vijay Kedia sir simply look disruption. If you doesn't understand anything about it, avoid it. Stop. Do not touch that. Stop touching it. Do not touch that. Which means if let's consider nowadays that there is a huge craze of AI, but I doesn't understand any single what is going on about AI, what how AI is helping, how they will generate revenue. So for me, I doesn't understand about anything about it. So I will avoid in investing there. These are the simple view of destruction by Sir Vijay Kedi. Now let's move towards the next part, which is about the personal net worth in an equity. Vijay Kiryasar consider is everything is an equity. It almost is 80% of net worth is an investment, is an in equity, and is 20% of net worth is in real estate. He invests in the real estate to earn the rental income, which help him to meet his daily expenditure. Now, let's talk about the compounding. Sir Vijay Kedia has compounded his wealth in the last 15 years. In an initial 15 years, he had compound his wealth was only 5 lakh. From that from that 5 lakh in the last 15 years, he had compounded his wealth more than 100 crores. So now let's discuss about the daily routine of Vijay Kedia. He starts his day with the physical and mental exercise. His daily regimen includes newspaper reading, stock market news, social media scrolling about stock market, and a few regular meetings. So let's discuss the fourth and one of the most important part, which is common reason for the failure. Sir Vijay Kirias had highlighted the two common reasons for the failure are education with a lack of courage and investment with a lack of patience. These are the two common reasons for the failure while investing in a market. Let's understand the first reason. Education is not important. Along with education, one should have a strong courage to bet big. Without having the strong courage and conviction, one cannot make big money in the market. Let's take an example. If a person has read 5, 6 investment ideologies book, some personal finance, some about price data movement, some about technical analysis, some about financial analysis, some about business analysis. But a person doesn't have a strong courage to bet big. So that person will not able to make money in the market. These are the reason for the failure in the market. Now let's move towards the second reason, which are investing with a lack of patience. The person invest in the market and withdraw the market when the market fall by few percent. So, so the person are not making their wealth compounding by withdrawing their investment. Let's take an example. If a person had invested 10,000 and if due to the market had fallen by 10%, the investment value will become 9,000. Person will started withdrawing that investment. They will not further compound their wealth by staying investing. So these are the two common reasons for the failures in the market. Now, after discussing about the failure, we will move towards the last part, which is what are the key to success in the market. Vijay Kedia sir highlight the key to success in market is as many as a stock failure and as many as a bear market you had experience, which will develop your understanding and discipline investment approach, which are the key to success in the market. Now, to success in the bear market, you should consider as a bear as your friend, and you have to invest during the bear time, during the down when the markets are down. Then only you will able to make a big profit or the big investment amount in a market. So most people have developed their wealth by investing during the bear market.
In this slide, we will discuss about the various questions which our author had put to Vijay Kedia sir and the reply of a Vijay Kedia sir to the author of that question, which are discussed in the masterclass. This slide is divided into the three parts. First, we will understand about the portfolio performance. Then we will move to the about timing the market, and lastly, we will move towards the futures and option trading. So let's begin with the portfolio performance. The portfolio performance of Vijay Kedia has included major investment in which one or two stock have given the return like 30x, 50x, or 100x. Means these stock are the multi-bagger stock, and the other major investment give the minimal return like between 12 to 20%, and the few stock that doesn't have give return in a long run. So these are the basically the portfolio performance of Sir Vijay Kedia. As the masterclass book was written around the period of 2017-18, we had taken the change in portfolio of Vijay Kedia sir, which had shown in the graph here. So let's move to the graph. So these are the company name in which Vijay Kedia sir was invested in January 2018, and these are the holdings in the December 2019. These are the holdings from the September 20. We had taken the charge from the ACE equity as on 28 January 2019. So you can see the chart and deeply understand about the holdings of Vijay Kedia. Now we will move towards the next part, which is about the timing the market. Timing the market is precisely a challenge, but over the years, one person is investing in a market has experienced the market, can easily judge about the extremes and the tops of market. One cannot exactly time the market, but one can have a general idea about what are the market conditions going on. Now, after learnings from the timing of market, we will move towards the third part, which is about future and option. Future and option are used by the Vijay Kedia sir for the short-term trading. It tend to have higher profit when there is strong market movement. However, he mostly lose money in the futures and option. It is important to know that majority of time loss occur in futures and option trading by Sir Vijay Kedia. So he partly do future and option trading. He only do future and option trading when there is a strong momentum in the market. So here we will end the macros and personal part, which basically discuss about the questions which the author has asked to me. So let's discuss the last part of a macros and personal, which is advice to the new investor. So let's begin. Sir Vijay Kedia advice to the new investor. Let me first use a spotlight. Sir Vijay Kedia's advice to the new investor is to start learning from the NSE and BSE stock market course. At the same time, he also advised to invest in the mutual fund, as well as he suggests to read about the stock research report, attending management interviews to learn about the new industry. And the kind of self-learning that a person will develop will be more than a learning that person has learned from any reputed college. So what are the learnings here? Say Vijay Kedia want a new investor to learn from the basics from the various websites, from the stock exchange or other tech websites. At the same time, he also recommend person to invest in the mutual fund. So what are the benefit of investing in mutual fund at the time of learnings from the stock exchange? When the person is learning about a stock exchange, it will take 2-3 years to develop the understanding about a stock exchange. But if a person only will learn, he will miss the important opportunities. So he recommend to invest in the mutual fund at the time of learning. So the person will not miss the important opportunities for investing. Now, he also recommend to read a various stock research report and attending management interviews to learn about the new industry. The kind of a style of learning which a person will develop will be more than the learning that person had learned in any reputed college. So let's move to the various websites in which anyone like a new investor can learn from stock exchange and develop their understanding. Let me switch to my Chrome. This Chrome is visible. All right. First, a person can learn from the NSE stock market course, in which there are the various part. The person can learn the various things from here: technical analysis, option trading, finance and non-finance, currency market trading strategies, and etc. The next website is of some brokers website like by Zerodha, which provide a deep understanding for stock market, technical analysis, fundamental analysis, future trading, option trading, for professional option professional on option strategies, etc. So These are the various websites in which the person can start learning and adopting their understanding about the stock market. At the same time, he also recommend to invest in the mutual fund. One can easily open in the account in demat account in any brokers and start investing in the passive ETF. In the ETF, so that they will able to earn the return like a benchmark. Vijay Kedia also suggested to read more about like a broker report or the research report. This is a research report on the Tata Steel, which is by IDBI Capital. He recommend the new investor to start learning from this research report, like understood various ratios, how they are computed, and any other stuff. He also recommend to read about the broker research report. This is a broker research report by Motilal. This is a broker research report on HDFC Bank by Motilal Oswal. He also recommend to learn from such broker research report. At the same time, he also suggests to learn from some national and international journals like this is a journal of iron and steel industries in which a person can easily able to get insight about this iron and steel industry. He also recommend to attend a management interview, and at the same time one can also get insight of management interviews by just reading concords. So here is a con call of a relaxo footwear. One can easily understand what the management is discussing about the business and any other stuff. These are the basic tools from which one can understand about the stock market. So let's switch to the part facilities. After understanding of the point one, we will move towards the point. In the point two, there is discussion about it will take around 2 to 3 years for the person to develop the understanding of a stock market. After that, a person can decide whether they have to directly invest in the stock market or they have to invest via passive approach. Now, we will move towards the third, which is one of the most important characteristics of stock exchange is it is high risky, high profitable, high volatile. But people often consider stock market as a gamble. Stock market is not like that. Stock market requires various skill sets like patience, courage, strong conviction, understanding of various methodologies, deep learning, etc. So one person can invest in the stock market by possessing the various skill sets which are required for investment in stock market. Now, we will move to the fourth one, which is in which the Vijay Kedia says that there are around 6,000 listed Indian companies, out of which 5,000 companies are like a garbage stock. So, what are the garbage stock? Garbage stock are the stock which basically have management issues or an issue of governance, issue of issue with the other businesses, issue with the law and orders, etc. How one can identify the good business? For identification of good businesses, Vijay Kedia sir recommended to look at the management track. What do you mean by looking at a management track record? Management track record is simply looking at the integrity of management, how management discusses its business to its investor, honesty of management, etc. These are the various checkpoints which an investor should look about the management. Now, he also suggests to read about the various broker research reports, and various industrial research reports. Here we will end the macros and personal. Hope you like the video.
Welcome to the part. This is the conclusion part where we will discuss the similarities and contrasting ideologies between the Damani sir and Kedia sir. So let's move on forward towards understanding the similarities between Damani sir and Kedia sir. So let's move on towards similarities between the investment ideologies in between Damani sir and Kedia sir. So the first of all point we will discuss is long-term investment. Yes, we have gone through various aspects and various points where we have discussed that they have been invested for long term, and because as the name suggests, long term believes in buy and hold, because where they found the company's fundamentals to be strong and they believe in creation of the wealth. Basically, they believed that where your conviction is strong, where the fundamentals are strong, where they have done proper analysis, they basically believe in creation of the wealth, by investing in that particular stock or a company for a long period of time, right? So, as long-term investment suggests, they both basically focuses more on the potential growth and stability of their investments as they analyze the good fundamental of the businesses. And we can connect this point with the part where the money sir still holds, saying that they still holds the Sundaram Finance and ITCs, like such kinds of business. Those kind of long-term investors are basically less concerned about the short-term fluctuations happening in the market, because they believe that they are basically because of the market sentiments and mood of the market, where we have also learned that where the underlying logic remains the same, you will know that you will most of the time you will be go fine. So like this kind of the similarities between them, where we have discussed the long-term investment part. So the next point is value investor philosophy. Value investor focuses on identifying undervalued securities in the market because they believe that the market sometimes misprices the stock, and they actively search for companies that are trading below their intrinsic value. Because both Damani sir and Kedia sir are value investors, and both of them follow the approach to find the companies with the good fundamentals at cheap valuation, because they believe that the potential growth of the business, and that would lead towards aiming buying those kinds of companies at their favorable prices. Both of them focuses on identifying the undervalued stock, because also they also believe that the potential returns from the investment in such kinds of undervalued assets will outweigh the risk over the long run, right? You could connect this with something investments done by the Money Sir and Kedia Sir, where we have already discussed, like in the case of McDowell's, like why the 160 crore of valuation was still cheaper for McDowell's, because considering the Indian alcohol mark industry valuation and all. Then in BEL, BEML, Aegis Logistics. I hope you guys have must be familiar with such kinds of investment. So you could connect with this point that how they both of them contains the similarities of value investing. The third point that we will discuss over here is focus on research and due diligence, right? Both Damani sir and Kedia sir emphasize the importance of conducting research and due diligence before making investments decisions, right? They both analyze the financials of the company, industry trends. Financial includes the balance sheet then income statement, cash flow statement, then management quality to make informed choices. We have learned this to various examples, where in the money sir, where in McDowell's there was something talk about corporate governance issue, where they got cleared with Mr. Malia's personality. Then in the case of Vijay Kedia sir, Atul Auto, they also take active part in the management, right? So such kinds of research and due diligence they follow. There is a very beautiful quote in the Psychology of Money book by Morgan Housel, that doing nothing and staying inactive are two different things. This both of their investors follow that approach, because not only before making the investment, even after making the investment, they were having active part in the investment, and they were also constantly analyzing the company, right? Because doing nothing and staying inactive are totally different. Doing nothing is you are sitting, you are watching your investment, you are analyzing, but yes, you are not doing anything with the company, right? But you are analyzing, and you are analyzing how's your company performing after investing also. And staying inactive refers to is you not even touching any annual report, or not even taking care of your investment after investing money in that, right? Such kinds of ideology they follow, because they read annual reports, they believe in financial statement analysis, book reading. Remember in the money sir also we discussed the three-step process. First one was of EVA and market cap analysis, then second one was bottom up approach. They follow the bottom up approach. Basically we discussed that reading financial reports and other research reports, and they believed in taking their investment decision through this approach by focusing on research and due diligence.
Moving on to the next point, which is emphasis on risk management. So what I've written here is both investors understand the importance of managing risk in their investment portfolios. They prioritize capital preservation and aim to minimize downside risk while seeking attractive investment opportunities. So basically, as we have seen earlier, that how much they focus on the risk associated with their investments. They go through the company's fundamentals. They assess the management, and this point also correlates to one of the most influential saying by Sir Warren Buffett. Rule number one: don't lose money, and rule number two: don't forget rule number one. So that's what this risk management is about, where they prioritize the capital preservation rather than generating returns. The next point would be contrarian approach. Contrarian approach is where they are willing to go against the crowd and investing in companies or sectors that are overlooked or undervalued. As we have also saw in the case of Mr. Ramesh Damani, as he mostly invests in PSUs, which are public sector undertakings, and how they are overlooked as garbage stocks, as they do not really generate much higher returns. But we have seen before that how these 10 to 15% of slow compounders lead to generating higher and higher returns. And also talking about undervalued, we have also seen in the case of Mr. Kedia of how he buys unknown and undervalued stocks. They seek out on opportunities where they believe the market has not fully recognized the true value of the growth potential of a particular investment. So the basic point of contrarian approach would be, to put it into simple words, to buy gold who is now available at the price of copper. So that's how their investment ideologies are. The next topic would be strong focus on learning. They have always encouraged us to do mistakes, but to learn from our mistakes, and then to not repeat them. Doing mistakes is one thing, learning from mistakes is another thing, but the only message here is to not repeat them. So both investors continuously learn and improve their investment skills. They stay curious, read extensively, and learn from their experiences and also the other experiences of other successful investors. As we have seen in the case of Mr. Vijay Kedia, of how he learned the valuable lesson of holding the stock for a long term. If you know that the company will grow no matter what the price fluctuations, and he learned that lesson from studying investors such as late Mr. Rakesh Jhunjhunwala, Sir Warren Buffett, and Sir Radhakishan Damani. So that's it for the similarities between these two investors. Now let's move on to the differences between them. Understanding the similarities between their investment ideologies, let's move on to understanding the differences between their investment ideologies. So starting off with stock preferences, Vijay sir often mostly look for companies with unique business models, disruptive products, or niche market positions. He focuses on identifying potential multi-bagger stocks with high growth potential. As we have seen in the case of the smile ideology of investing: small in size, medium in track record, uh, large in aspirations, and extra large in potential. And he only buys company if it is trading at a PE ratio of 10 or below. And if he is buying companies at a higher PE, he expects it to grow at around 20 to 25%. Whereas, on the other hand, Ramesh Damani sir considers a broader range of factors, including industry trends, financial performance, and management qualities when selecting stocks. So, we can conclude here that Vijay Kedia sir have more of a bottoms up approach, whereas Ramesh Damani sir has more of a top down approach. The next point is risk appetite. Mr. Kedia has shown a willingness to take higher risk by investing in smaller companies with higher growth potential. As we have already discussed it in the SMILE principle, the S stand for smaller in size. He only invests in companies which are either small cap or mid cap. Whereas Mr. Damani tends to have a more balanced approach, considering risk management as an essential aspect of his investment strategy. And don't get me wrong, risk management is also an important aspect of investment ideology of Mr. Vijay Kedia. But his tendency to only invest in stocks which are small cap or mid cap, which can be highly volatile, as we have already discussed earlier, the risk appetite of Mr. Vijay Kedia is seen to be higher than Mr. Ramesh Damani.
So next point in the contrast between the Mani sir and Kedia sir is investment style. Vijay Kedia sir is known for his expertise in identifying and investing in small and mid cap stocks with high growth potentials, right? So, you can correlate this thing with the smile principle, right? And whereas Ramesh Damani sir, on the other hand, would like to have more diversified portfolio. Because they wanted to involve in all large cap, mid cap, and rest of the small cap stocks also. Right. You will be able to correlate this with the second point, which is approach to portfolio concentration. Right. Kedia sir is known for maintaining a concentrated portfolio with a limited number of high conviction stocks. Because they stated in their interview that they are happy with only having even two companies with a high conviction and a high potential growth on a yearly basis, right? So they are happy to have only two companies with high conviction. But whereas on the other hand, the money sir has and habituated with analyzing dozens of company over a particular period of time, and you can correlate it with that because they do have diversified portfolio, so they would like to have large cap, mid cap, small cap, all kinds of stocks, right? Moving on towards the investment horizon, you can correlate it with that Kedia sir initially didn't had that mindset of having long-term investments, because they were initially traders, then they move on towards investing, and then they were inspired by other long-term investors like Rakesh Junjunwala sir and other long-term investors, right? Whereas on the other hand, sir, from the initial stage, believed in creating wealth on the long-term basis, right? So I hope you guys would have understand and the similarities and differences between Ramani sir and Kedia sir, right? So here we guys end up discussing the key aspects with Vijay Kedia sir. I hope you guys would have understand all the concept. Just a quick note for our viewers that we also have extracted such learning from the masterclass book only, using our own personal insight. So we could be wrong somewhere, right? Hope you guys enjoyed learning investing ideologies and mindset of such legendary investors in our masterclass series. Stay tuned for more updates. Thank you so very much, guys, for joining us in this masterclass series.